The real danger in finance appears when prices seem calm, stable, and controlled, while hidden stresses quietly grow underneath, weakening the entire system without public awareness. Markets rarely collapse during panic. They usually break when confidence is highest, and celebrations distract attention from silent structural failures forming in the background. While most people welcome the new year with optimism and fireworks, a far more important financial event unfolded quietly, unnoticed by the majority of global investors. This moment may later be remembered as the point where silver's pricing system permanently changed direction, even though almost nobody recognized its significance at the time. Exactly at midnight on January 1st, 2026, China enacted a legal change that immediately altered how silver moves across global supply chains. This decision was not a proposal, warning, or rumor circulating online. It was official law, effective instantly, with no transition period for markets to adjust. From that exact moment forward, silver exports leaving China stopped operating under normal commercial rules that global markets had relied on for decades. Once you understand how deeply the world depends on that Chinese silver flow, screen prices begin to look misleading, incomplete, and increasingly disconnected from reality. Many investors still believe silver trades at one universal price visible on charts, but that assumption stopped being accurate the instant the new year began. What exists now is a fractured silver market where paper pricing, physical pricing, and strategic industrial pricing all communicate completely different economic truths. Whenever markets fragment this way, history shows paper prices resist reality the longest, adjusting only after physical stress becomes impossible to ignore. If you're watching silver trade near $72 and assuming nothing meaningful has changed, you are already lagging behind what serious participants understand. That quoted number increasingly functions as a placeholder, not a real transaction price, because meaningful silver trades are happening elsewhere at much higher levels. To see reality, we must examine what the largest and most powerful buyers are actually paying for guaranteed physical supply right now. On the Shanghai exchange, where silver is delivered for real industrial use, recent trades occurred near $84.55 per ounce. That price matters because it is paid by companies that cannot operate without silver, not by traders speculating on charts or momentum indicators. Solar manufacturers, battery producers, and state-linked industrial groups are buying silver aggressively because uninterrupted access determines whether their production continues or stops entirely. These buyers act early when shortages appear, long before mainstream financial media acknowledges any problem forming within the global supply system. They are not purchasing silver because it is fashionable or trending. They are buying because without it, factories shut down and revenue instantly collapses. Now compare that industrial pricing reality with what is happening at the street-level physical silver markets worldwide. In regions like Dubai and across the United States, physical silver premiums have surged dramatically in a very short period. Premiums around $14.50 over spot have become common, pushing real transaction prices toward $80 or higher. Popular coins such as American Silver Eagles are selling near $86, assuming buyers can even locate available inventory. The widening gap between screen prices and actual purchase prices is not random noise. It is a clear distress signal from the market. This price divergence represents the market loudly communicating that the traditional pricing mechanism is malfunctioning under real-world pressure. Under normal market conditions, such price gaps cannot survive for long due to arbitrage forces correcting inefficiencies rapidly. Traders would normally buy cheaper silver in one market and sell it into higher-priced markets, closing the spread almost immediately. That self-correcting arbitrage mechanism has now failed, which signals something far more serious than temporary volatility. The price difference between Shanghai's physical market and New York's paper market expanded to roughly $12.40 per ounce. That represents nearly a 17% gap, something that should be mathematically impossible in a properly functioning global commodity market. The only reason such a gap can exist is because silver can no longer move freely between paper promises and physical delivery channels. Effectively, the bridge connecting futures contracts to real metal delivery has been broken by supply restrictions and logistical barriers. Price alone does not confirm this breakdown. Market behavior provides even stronger evidence of what is unfolding. Physical delivery demand suddenly exploded, signaling that large players stopped trusting paper exposure and demanded actual metal instead. Only days earlier, 69 contracts stood for physical delivery, representing roughly 345,000 ounces of silver. That level indicated a mostly paper-based market where few participants required actual delivery of metal. Almost overnight, delivery requests surged to 1,847 contracts demanding physical settlement. At 5,000 ounces per contract, that single cycle represented over 9.2 million ounces demanded immediately. That behavior is not speculation. It is a physical run on silver by informed participants acting decisively. This shift was not gradual or emotional. It was sudden, calculated, and synchronized across large institutional players. Major buyers saw the calendar flip, understood China's export controls instantly, and demanded delivery before supplies tightened further. Anyone short those contracts suddenly owed millions of ounces that became extremely difficult to source. Silver could no longer be easily obtained from China or cheaply acquired in open international markets. Yet contractual obligations remained, forcing short sellers into an increasingly dangerous position. This is where the banking system becomes critically exposed, and this aspect carries the greatest systemic risk. Banks holding large paper silver shorts had promised metal they did not physically possess. Once delivery demand surged, those promises turned into immediate financial liabilities. To remain solvent, emergency liquidity became necessary almost instantly. Over 48 hours, the Federal Reserve injected approximately $5.8 billion into the repo market. This was not economic stimulus. It was urgent damage control aimed at preventing cascading failures. The fact this occurred during a holiday period highlights how severe the situation became behind closed doors. Consider the math involved in these short positions under current conditions. Buying silver near $84 to deliver contracts priced near $72 creates roughly $12 loss per ounce. Multiply that loss across millions of ounces, and financial damage escalates at an alarming pace. This explains reports of delayed settlements, rising loan loss provisions, and vague administrative explanations from financial institutions. Meanwhile, physical inventory levels continue collapsing at an unprecedented rate. In Shanghai alone, over 84 metric tons of silver were withdrawn within just 2 trading days. Under normal conditions, daily withdrawals average closer to 2 metric tons. Current inventory has dropped to approximately 727 metric tons remaining. At the present withdrawal pace, inventories could be exhausted in fewer than 20 business days. This outcome is not theoretical speculation. It is simple arithmetic based on observable data. Industrial buyers are responding accordingly, shifting from just-in-time inventory management to outright stockpiling. Companies like Samsung reportedly moved to secure 6 months of silver supply in a single action. Tesla and other manufacturers face similar pressures as silver availability becomes uncertain. For these companies, price differences between $80 and $90 are irrelevant compared to supply certainty. No silver means no production, and no production translates into massive financial losses very quickly. This marks a transition where silver stops behaving like a passive investment asset. For decades, silver remained artificially cheap as paper markets expanded faster than physical supply. That imbalance is now correcting, and the paper pricing era is reaching its limits. Silver is increasingly treated as a strategic resource rather than a speculative commodity. Strategic resources rarely remain cheap when supply chains fracture and availability becomes uncertain. Mining cannot solve this problem quickly, even with significantly higher prices. Most silver production comes as a byproduct of other metals, limiting rapid output expansion. Even under ideal conditions, New mines require a decade or more to meaningfully increase supply. Recycling channels are already operating near capacity and cannot bridge the growing deficit. Last year's structural silver deficit approached 200 million ounces. Projections indicate that deficit is likely to grow substantially this year. Monetary policy cannot print physical silver into existence to solve this imbalance. The silver-to-gold ratio reinforces the same message emerging from physical markets. Historically, that ratio hovered near 15-to-1 based on geological availability. Even with silver near $85 and gold around $3,000, the ratio remains distorted. If markets fully price silver based on scarcity rather than paper convenience, current levels may appear cheap later. What happens next depends largely on how authorities choose to respond. They can continue supporting paper markets through bailouts, risking even higher silver prices. Or they can allow paper failures, potentially destabilizing confidence across commodities. Neither path is painless, and both carry significant long-term consequences. We appear to be witnessing the early phase of a transition toward physical-based pricing reality. The key takeaway is not panic, but awareness of how markets truly function beneath surface prices. Premiums, delivery demands, inventory drawdowns, and liquidity injections tell a clearer story than charts alone. Stay informed, question visible prices, understand paper versus physical exposure, and subscribe for continued independent analysis ahead.